So there's a lot of allocators in the audience today, and I think one of the trends we've seen pick up pace over the years is allocators wanting to do direct investing themselves, clamoring for co-invests, investing with funds and GPs just to get co-invest for later on rounds. Please don't take offense to this, my allocator friends. There are many of them in this audience. I think a lot of people are mistaking bull market for brains, and I think a lot of people believe that they have become VCs themselves and think they're really smart at it. And some great deals are going to get done, and people are making money. We personally are taking a more cautious approach and trying really to rely on GP advice on when to allocate and what companies to allocate to. But do you guys have any opinions on your investors' appetite for co-invests and the way you guys approach it? Adrian, do you have a thought?
Sure, I can just. It runs an entire gamut. Most of our co-investors are usually with family offices rather than kind of endowments and other types of institutions. But we did have one kind of notable example. Our biggest returner in our first fund was Pipe, which actually the founders here in Miami, and in Greenspring came in and led one of the rounds, and after we had done a couple. And I think it's turned out very well for them. And I don't think they do a ton, but they look to be strategic, and that's probably the best thing. And we were a big source of the diligence. We could tell them everything we needed. Marlon had worked with this founder going back even before Pipe, so that was very helpful.
I would look just again at abundance and scarcity. So if there's a scarce allocation in a round and it's a truly hot company, as I think that was, if because you are an LP in a fund and they're doing some sort of co-invest or some SPV or it's probably an attractive opportunity. If the company is struggling, needs to raise cash, you have to ask the question, why am I getting this call to participate in something? Yeah.
It's like when an energy deal finds its way to LA, we're like, wait, it got out of Houston, made its way all the way to LA, there's a problem with this deal if it's showing up on our desks.
Yeah, so I would just be very wary of adverse selection, really question, why are you getting this deal? Is it because you're an existing LP and a GP? And when we did co-invest funds, it was typically for a company that we didn't want to give the allocation to a growth fund or somebody else. We wanted to take it ourselves, so it was born out of greed, not fear. But if you see a company that had a high mark and then is struggling to raise money, and you're looking at the syndicate and you have relatively low participation from the existing cohort of investors, and suddenly it's being opened up to new people, it's time to run.
I mean, another thing I think that it points out is that there's a premium now on what I call an undervalued asset, which are pro rata rights. When an early stage fund, all of us are early stage, start to grow a company up and it gets to the series B, C, D, often our funds are tapped out. And so we've done on 5 occasions SPVs, special purpose vehicles, at greatly discounted fee structures just because we want to let our LP base have that opportunity. And I think that's a nice idea. So a lot of people are starting to do opportunity funds. That's, I think, an interesting thing because you have inside knowledge, you have timing ahead of time because you know the pacing of when they're going to raise, and you have the rights that nobody can take away.
I do think David hit on something when it relates to opportunity funds as part of our strategy, which are special situations. How do you get it into a late stage business but at an early stage price because there's some dislocation? I have a lot of respect for David. I'm going to disagree with the idea, not with him personally, on corporate venture. I think that corporate venture is almost always done at a peak and is almost indicative of in a coming decline. And I think it's a great opportunity. We've done a ton of these where there's going to be divestitures, where the new guy comes in and the board says, wait a second, what are we doing here? And they start to dump their stakes, whether it's in LPs or companies at rock bottom prices. I think it's an amazing time, and I have no dog in the race here, and it would take allocation away from me should you decide to go into these. But distressed funds, secondary funds, anybody that's going to be a liquidity provider, again, under that rubric of capital abundance and capital scarcity, I think capital is going to be very scarce in the coming years, and people that have it to be able to bail out, whether it's pro ratas, people that are stuck in LP positions and can't fund them, individuals, families, corporates. I think it's going to be an amazing opportunity to get really cheap deals.
I mean, I think the name of the game right now is everyone needs to be creating a war chest. You need to be telling the founders that inside your portfolio that they need to be creating a war chest, and you as a fund manager need to also be creating a war chest, because there are going to be great deals that are going to happen in the next, year and a half or so, and you need to have capital to do those and execute.